When most people think about a real estate purchase, the investor and the lender are the only two players that usually come to mind. But in real estate private equity, this starts to get way more complicated with multiple different partners and capital types that often come into play. So in this video, we'll break down the main sources of capital that real estate private equity firms use to fund 8- and 9-figure transactions and the inner workings of each of these. So in real estate private equity, the combination of capital sources used to fund a transaction is typically referred to as the capital stack. And each of these sources has its own unique risk levels, interest rates, and monthly payment requirements, with the highest risk and highest cost funding options sitting at the top of the capital stack and the lowest risk and lowest cost funding options sitting at the bottom of the capital stack. And the first capital source I want to mention here is used on almost every single transaction in real estate private equity, and this is the senior loan. This is going to be your standard first position mortgage from a bank, life insurance company, agency lender, or even a debt fund, and this is also typically going to be an investor's cheapest source of capital. And the reason why this capital tends to be so cheap is because a lender in this position has first payment priority and sits at the very bottom of the capital stack, meaning they get their money back first before any other investors. Now, in most cases, senior lenders will be willing to fund between about 60% and 70% of the total cost of a project, which leaves about 30% to 40% that needs to come from other sources. And the most common funding source in real estate private equity, in addition to senior debt, is what's referred to as common equity capital, and this is usually going to come from two different sources. The first source is going to be the general partner or the GP on a deal, which will be the private equity firm itself that's managing the investment. And the second source will be the limited partner or LP on the deal, which is a passive equity partner with little or no control. Now, because the GP will be the partner that's responsible for managing the investment overall, they're typically only expected to contribute between about 1% and 10% of the total common equity requirement, with the LP or LPs making up the rest. And from a payment priority perspective, common equity typically sits at the very top of the capital stack, meaning that these investors are the last to be paid among all capital sources. But even with that level of risk associated with being in this position, this still tends to be an extremely attractive option for limited partner investors, since this is typically the only way to invest in real estate passively without a cap on your upside. And from a GP's perspective, this also tends to be a really attractive place to be because of the fees you're able to charge to LPs for managing these investments, along with performance-based incentives that often kick in as certain return hurdles are hit. Now, for the majority of real estate private equity investments, the story ends here, and between GP equity, LP equity, and senior debt, a commercial real estate deal will usually be fully funded. But in some cases, there are a few additional sources of capital that can come into play that are primarily used to reduce common equity requirements and increase common equity returns. And to make this happen, another funding source that sometimes comes up in real estate private equity is an additional layer of debt on top of the senior loan, and this is usually referred to as a junior or mezzanine loan. In most cases, mezzanine loans are used to fund anywhere from between about 10% and 15% of the total cost of a project, which can often increase the loan to cost ratio on a deal to 80% or more. And while this increases the risk to equity partners on an investment, this is also a risky position to be in for the mezzanine lender itself, since this capital source sits behind the senior lender when it comes to payment priority. And to compensate for this risk, mezzanine lenders tend to make these loans significantly more expensive than a first position mortgage, with interest rates that might be double what a senior lender would charge. Now, when mezz debt is used, this is typically done with the goal to increase projected returns to equity investors, since profitable deals will usually look even more profitable on paper the higher that loan to cost ratio is pushed. However, when that LTC ratio increases, this also reduces the margin for error that investors have when cash flow drops or when values fall in the market, which tends to make this somewhat of a last resort for borrowers to get a deal across the finish line. Now, there's one more capital source I want to mention here that's been particularly relevant for investors over the last few years, and this is what's referred to as preferred equity. Preferred equity is often used to get common equity requirements down to 15% or even 10% of the total cost of a project, with some pretty unique payment structures that can make this really expensive. Most of these deals will start by including a current pay rate, which functions very similarly to a standard interest rate on a senior or mezzanine loan, where scheduled payments are made on a regular monthly basis. But in addition to this current pay, many preferred equity structures will also include what's referred to as an accrual rate, which is an additional payment on top of that current pay that's owed to the preferred equity holder when that property is ultimately sold. Now, this capital is so expensive because preferred equity sits behind both the senior and mezzanine lenders on a deal, which makes this one of the riskiest positions to be in aside from common equity. This is also why you'll tend to see preferred equity used most when a market is overheated and companies are doing everything that they can to outbid other buyers, or like we saw over the last few years when companies need rescue capital to pay off existing loans. Now, again, most commercial real estate deals are funded exclusively with common equity and senior debt, so every available capital source out there won't come into play on every single deal, but these are the most common funding options that you'll see throughout this industry. It's also worth noting that although I'm referring to private equity firms in this video as general partner investors in the common equity position, these companies can get very involved with every layer of the capital stack, and many of these firms have done just that at different points throughout this cycle. Now, how each of these capital sources can impact cash flows and returns on a deal can get pretty complex. And if you want to learn more about how each of these play into investment return calculations and how real estate private equity firms model these in Excel, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate acquisition and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on different real estate capital sources and deal structures, make sure to hit the like button and let me know. And let me know in the comments if there are any other sources of capital that you'd like to see covered in more detail in a future video. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.